Hello everyone, welcome to the Ashworth Wealth Weekly Market Update. My name is Todd McChesney. We'll kind of jump right into this week's slide. There's a lot going on this week, and I think the biggest issue is we're going to talk about gold, but a lot of it comes down to what's going on with the election tensions and geopolitical tensions. There's some fiscal concerns, a lot of things going on, and because of that, a lot of investors have flocked to gold as a safe haven. If we've ever had the gold discussion with you, you know that we're, as a general rule, not a huge fan of gold for various reasons, which we'll talk about. But for the most part, you want to look at this chart and just notice the difference between how gold has performed versus a historical 60-40, 60% stocks, 40% bonds balanced portfolio. You think about that, starting in 1987, the annualized return of a 60-40 portfolio is about 9%, whereas gold is under 5%. So it's a big difference on that. Doesn't mean that 2024 hasn't been a banner year for gold. Right now, gold is worth a little over $2,700 an ounce. It's climbed 30% this year. It's on pace for its best year since 1979. It's even set 41 all-time highs. But gold doesn't produce income, so its price is typically inversely correlated to real interest rates. So with that, I think there's a lot of people that are concerned, thinking, where can I go for a safe haven for my money? The problem with gold, as I mentioned before, it doesn't pay interest. It's basically based just off supply and demand. And so when you look at a portfolio, having money in gold can be very problematic. Yes, you can turn gold to cash, but there's no dividend, and it really comes down to are there more buyers and sellers. It's not like you can say, hey, I've got this stock. Let's say I bought Apple stock, and Apple comes out with a new iPhone or some new product, and people want to buy it, and the income shoots through the roof. That never happens with gold. Gold is just supply and demand. It has nothing to do with what they're producing, etc. Another thing you have to be careful about with gold is it's just not a great long-term investment. If you look at the chart again, the 3-month T-bill, which effectively follows inflation, annualized return of T-bill is about 3.1%, gold 4.8%. I had one person once tell me that if you go back 2,000 years ago at the meridian of time, a gold piece would buy you a robe, a pair of sandals, and maybe a belt or a sash to tie your robe together, and that's what you could buy. Today, a gold piece would buy you a nice suit, a nice pair of shoes, a tie, and a shirt, and a belt, that type of thing. So gold hasn't historically grown in value. It pretty much is just an inflation hedge. Years ago, I attended the Berkshire Hathaway shareholder meeting with Warren Buffett and Charlie Munger in Omaha, Nebraska. And somebody asked him the question when they say, hey, Warren, why aren't you buying gold? Isn't gold a great investment? And Warren thought about it for a few minutes, and he said, I think investing in gold is a great hedge against making money, which is really how we kind of look at it as well. Gold is not a great long-term investment, but it is a good hedge against inflation, and that's about it. Stocks are also a good hedge against inflation. Real estate is a good hedge against inflation. So those are kind of your three options. It's either a tangible like gold, it's a real estate investment, or it's equities or stocks. And so we think that the stocks are better long term. You can see just even on a 60-40 portfolio, they've outperformed gold almost 2 to 1. And so over the last almost 40 years or so. So anyway, that's the we wanted to kind of get the point across. We're watching what's going on with the election. There's a lot of things we've got to be aware of, and we have our annual tax webinar coming up. We'll record that and send that out in the next 5 to 7 days or so. We'll talk more about the election then. But the big thing is this: there's a pretty good chance that we're not going to know who is going to be in the White House for a week or two, maybe even longer. We're not concerned about that. We believe that portfolios are structured in such a way where we have access to fixed income, we have access to equities where needed, and we're not too concerned about the comings and goings of the 24-hour news cycle. In the long run, companies make money because they make money, not because of who's in office or who's making which political decisions at that time. So in the long run, if companies are profitable, they're going to grow in value, and that's how we have your portfolio structured. So As usual, if you have any questions, feel free to reach out. We'd love to chat. We'll look forward to answering any questions that you have. Feel free to forward this to anybody that you want to. We're more than happy to answer their questions as well. And if you have anybody that you want to add to our distribution list, just let us know as well. We just need their email address and name, and we can do that. Until next time, we'll let you run, and we'll talk to you soon. Bye-bye.